Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
As of February 20th, 2026, authID Inc., ticker AUID, is trading at exactly $1.38 per share.
Right. And, let's just be honest. That price is a brutal reality check. It represents a 74% decline from the February 2025 peak of $9.58. So we are looking at a market capitalization somewhere between 18.8 million and 21 million. Basically, the market has, left this company for dead.
Yet, despite sitting firmly in what many would call microcap hell, the trading activity tells a very different story. The 90-day average volume is sitting at over 4.7 million shares. People are definitely watching this. There is high active interest here, despite the depression in price.
Catching a falling knife. We are looking at a massive disconnect between the narrative of the technology, which sounds incredibly futuristic, and the reality of the balance sheet, which looks prehistoric.
That is exactly the setup. The core question on the table today is simple. Is this company poised for a 5x to 7x valuation expansion based on its proprietary privacy key technology and the coming wave of AI security? Or is it a distressed asset facing insolvency due to an alarming cash burn and a pivot that is just taking way too long?
Right. And I represent the view that financial gravity is simply undeniable. You cannot pay bills with a pipeline or great tech. The negative net revenue in Q3 2025 and the liquidity crunch pose an existential threat that, in my view, heavily outweighs the technological promise.
And I take the position that the market has fundamentally oversold this stock. Investors are reacting to backward-looking financial noise and ignoring a deterministic technology moat, along with a $20 million enterprise pipeline that is on the verge of converting.
All right, let's hear the bull case then. Why should anyone step in and buy a stock that's down 74% in a single year?
Because we are currently witnessing an inevitable shift in cybersecurity, and the market simply hasn't priced it in yet. We are moving from probabilistic security to deterministic security.
Hold on, let's define that for the listeners. Probabilistic versus deterministic? It sounds a bit like a statistics lecture.
It is actually quite simple. Think of the old way. Passwords, SMS codes, even your standard multi-factor authentication. These are probabilistic because they rely on shared secrets. If I have your password, the system probably thinks I am you. It is a guess based on possession of a secret. But secrets get stolen. In fact, they are stolen constantly.
Sure. Phishing, social engineering, we all know this.
Exactly. Now, deterministic security is biometric. It is not about what you know, it is about who you are. It is binary. You either are the person or you aren't. authID is a pure play investment in that transition. The legacy defenses are failing systemically against AI-driven attacks. Look at their strategic pivot. They realized the low end of the market, the Fast 100, these small, risky clients, was a dead end. They churned easily, they couldn't pay. So they moved to the Fat 100, large enterprise clients, contracts worth $500,000 to $3 million. This is the correct long-term move for stability. Furthermore, their privacy key technology solves the single biggest hurdle for biometrics, which is regulation.
You mean BIPA and GDPR?
Precisely. The Illinois Biometric Information Privacy Act, or BIPA, has cost companies hundreds of millions in settlements because they stored facial data improperly. authID's tech does not store biometric templates. It sidesteps those liabilities entirely. My thesis is simple. The current valuation of roughly $20 million is a ground floor opportunity before that $20 million pipeline converts to annual recurring revenue. You are essentially buying the IP for pennies on the dollar.
Okay, I hear the pitch, but I have to pull you back to the numbers, because great technology does not equal a great business. We have seen countless superior technologies fail because they ran out of money. Management has actually issued a substantial doubt warning regarding their ability to continue as a going concern. That is not boilerplate language. That is a siren.
It is a standard disclosure for microcaps in transition. It is an accounting requirement, not a death sentence.
It is a disclosure backed by frightening metrics. Look at Q3 2025.
Net revenue was negative 0.1 million. Let's just pause on that. They literally lost money on the top line due to concessions. Even if gross revenue grew, that negative print is startling. My thesis is that authID is in a race against time. They have a cash pile of roughly 4.9 million plus a recent 3.6 million raise.
That is runway.
Is it? These Fat 100 clients you mentioned, enterprises, banks, healthcare, they have sales cycles of 9 to 12 months. They have compliance reviews, legal reviews, budget cycles. The company is burning cash every single day while waiting for those signatures. They might burn through their liquidity before those deals close. You call it a ground floor, I call it a trapdoor.
That brings us directly to the core of the issue, the technology moat versus the competitive landscape. You mentioned the financials, but the financials are a lagging indicator. The technology is the leading indicator. We need to talk about privacy key because I don't think the broader market understands why it is different.
Please explain why this architecture is different from just using Face ID on my iPhone. Apple spent billions on that. Why does a microcap have something better?
It is fundamentally different in its architecture. When you use standard biometrics, there is often a template stored somewhere. On your phone, it is in the secure enclave. But if a company uses server-side biometrics, they have a database of millions of face templates.
Which is a massive honeypot for hackers.
The regulatory nightmare. authID's architecture converts facial biometrics into elliptic curve cryptography, or ECC key pairs. Here is the crucial distinction. The private key is discarded and recreated dynamically every single time you authenticate.
So there's absolutely no database of faces?
No. No database of faces exists to be hacked. The private key is generated from a live image, matched, and then destroyed immediately. This is privacy by design.
It sounds secure, I will grant you that. But does the market care enough to pay for it?
About a 700 millisecond processing time with a 97.9% first attempt success rate based on a recent retailer case study. In high compliance sectors like utilities and finance, good enough biometrics that field 10% of the time or store data at risk simply don't cut it. They need this specific architecture.
I am sorry, but I just don't buy that this moat is wide enough to keep out the giants. You were talking about a microcap company with fewer than 50 employees. Look at the board. You have Microsoft with Entra ID, you have Apple and Google pushing passkeys, and you have specialists like Okta and Ping Identity. Microsoft bundles this stuff for free.
Those are aggregators. They are generalists.
But basic biometric authentication is becoming a commodity. It is being bundled into the operating systems we use every day. Can a company this size really compete against Microsoft? If the no-storage approach is so vital, what stops a trillion-dollar company from replicating that architecture? They have the R&D budget to do it in a quarter.
If they could have, they would have. The privacy key and the way they handle the ECC pairing is patented and incredibly complex. But more importantly, the giants are focused on convenience. authID is focused on high assurance. There is a reason they recently launched the PIV framework solution for critical infrastructure, utilities, water, gas. These sectors cannot rely on Apple Face ID. They need NIST-compliant, auditable, server-side verification that does not hold toxic data. That is a niche, but it is a massive, high-value niche.
It is a niche, but niches get crushed by platforms all the time. Let's move to the catalyst you believe will expand that niche, which is agentic AI. You think this is the magic bullet?
This is genuinely the most exciting part of the thesis. We are looking at the mandate product and the Know Your Agent framework.
Know your agent, a plan know your customer?
Precisely. Think about where we are headed. By the end of 2026, it is projected that 80% of enterprises will be using autonomous AI agents. These aren't just chatbots answering customer service tickets. These are agents that can execute transactions, move money, change permissions, and write code.
Okay.
The problem is liability. If an AI agent does something illegal, if it moves $1 million to the wrong account or deletes a production database, who is responsible? How do you bind an AI action to a human sponsor in a court of law?
Currently, you mostly rely on login logs. Bob logged in, so Bob is responsible.
Which are easily faked and don't prove Bob authorized that specific action by the agent 5 hours later. authID solution provides an immutable, biometrically anchored audit trail for AI agents. The agent inherits the permissions of the human, and every action is tied back to that biometrically verified individual. This opens a brand new revenue category. It is no longer just about logging in. It is about governance of the entire AI workforce.
That is a compelling argument conceptually. It sounds like science fiction becoming reality. But have you considered the timeline? We are in 2026. The market is currently going through a year of reckoning regarding AI hype. Companies are realizing that implementing these agents is harder and more expensive than they thought. They are cutting speculative spend.
They are cutting fluff, yes, but they are increasing spend on security and governance. You cannot deploy the agents without the governance.
I am not convinced the budget is there yet. If the adoption of agentic AI governance is slow, if it takes 2 or 3 years to really become a compliance requirement, authID's runway is going to run out. They need revenue now, not in 2028. They are betting on a wave that might not crest until after they have drowned.
I disagree on the timeline. The EU AI Act is already effective as of 2025. The regulatory pressure is here right now. But let's address the elephant in the room, which you keep hinting at: the financial health.
It is not an elephant. It is the entire zoo. Let's look at Q3 2025 again. You glossed over the negative revenue earlier.
Let's contextualize it. You mentioned the negative net revenue of $0.1 million. That was a one-time cleanup. They granted $0.7 million in concessions to 2 specific Fast 100 customers who couldn't pay. They were cleaning up the bad debts from their old strategy so they could move forward with the Fat 100. It was basically taking out the trash.
Cleaning up is a very charitable way to put it. When a SaaS company has negative revenue, it means their churn is so bad it ate their growth entirely.
It was necessary pain, and the pivot is working. Look at the ServiceNow integration. That covers 85% of the Fortune 500. Look at the major key win with the global retailer doing $6 billion in sales. These aren't small clients anymore. And insider confidence backs this up. CEO Ronald DeGuro purchased shares at a premium $1.71 in November 2025. He paid more than the current share price because he sees the underlying value.
I come at it from a very different angle regarding the insiders. Yes, the CEO bought, but Director Steven Garchick sold 100,000 shares in December 2025 at around $1.06 to $1.09. That is selling at the absolute lows. If the turnaround was imminent, why would a director be unloading shares at near-record lows? That signals capitulation, or at least a need for liquidity that overrides faith in the company.
People sell for many reasons: tax planning, divorce, buying a house. Buying is usually a singular signal of confidence. You do not buy a dying company at a premium.
Perhaps, but let's look at the burn rate again. Operating expenses are $5.1 million per quarter. Their cash balance was $4.9 million plus the $3.6 million raise. Do the math? That gives them, what, 2 quarters of runway? Maybe 3 if they really stretch it. They are dangerously close to the edge.
They have reduced the booked ARR targets to be realistic about the longer sales cycles. They are managing the burn effectively.
But that doesn't stop the cash drain. They just raised money at $1.35, which was a discount. If they have to raise again in 6 months because those FAT 100 deals haven't closed, they will be raising at what, 80 cents, 50 cents? The dilution will destroy any equity value for current holders. They are in a dilution spiral unless they land a whale immediately.
I think you are severely discounting the pipeline. They state explicitly that the active enterprise pipeline is over $20 million in booked annual recurring revenue opportunities.
A pipeline is not a cleared check.
But it represents the potential, which leads us to the valuation scenarios. If they close even a portion of that pipeline, the math changes instantly.
Let's hear the math. Convince me.
Current ARR is roughly $1.7 million. The pipeline is $20 million. Let's assume they execute. If they hit $20 million ARR and we apply a conservative 7x multiple, which is standard for SaaS and cyber companies, that is a $140 million valuation.
That is a massive if. You're assuming a 100% conversion rate on the pipeline?
Even at a 50% conversion, you are looking at $10 million ARR. At a 7x multiple, that is a $70 million market cap. That is still a 3.5x return from today's price. The asymmetry is massive.
A 140 million valuation from a 20 million market cap is a 7x return. And that 7x multiple is conservative. High-growth private firms often command 10x to 15x.
But the risk is that valuation means absolutely nothing if you go bankrupt first. The market is pricing in execution risk. It is telling you that the probability of them failing to close those deals is high.
Or the market is simply inefficient and hates uncertainty. The market hates microcaps right now. That is exactly where the opportunity lives.
I would frame it differently. I think the market is pricing in a distress sale. If they run low on cash, they might get acquired by a larger player like Okta or CrowdStrike. But it won't be at a 7x premium. It will be a take-under or a low premium just to acquire the IP. That might save the technology, but it will not benefit the recent bag holders who bought in at $1.38 expecting $10. They get wiped out.
That is a possibility, I acknowledge that. But an acquisition is also a floor. The IP, the privacy key patents, the platform itself has inherent value. It is highly unlikely to go to zero.
In microcaps, zero is always a possibility. Let's consider the macro headwinds too. With the sovereign AI movement and the push for infrastructure that doesn't rely on hyperscalers, authID's ability to work without cross-border data storage is a massive geopolitical asset. That adds a layer of strategic value beyond just the basic enterprise sales.
Strategic value is great, but cash is king. We are circling back to the exact same constraint. They need to bridge the gap between the Fast 100 failure and the Fat 100 success. That bridge is made of cash, and they are running out of building materials.
They have enough to reach the next milestone. The ServiceNow integration and the PIV framework launch in early 2026 are the keys. Those aren't just press releases. They are distribution channels. ServiceNow puts them in front of the contact centers of the Fortune 500. That drastically reduces the friction of sales.
It reduces friction, but it does not eliminate the sales cycle. A Fortune 500 company doesn't rip and replace its security infrastructure in a month just because it is available in the ServiceNow store. It takes pilots. It takes convincing the CISO. That takes time. Time is the one asset authID does not have.
And yet, they have delivered 97.9% success rates for major retailers. The product actually works. In software, if the product works and the market need is acute, which it is, given the systemic failure of passwords, capital usually follows.
Usually. But in this interest rate environment, capital is very expensive.
I see why you are cautious. You are looking at the floor. I am looking at the ceiling.
I am looking at the runway.
Let's bring this to a close, because I think we've identified the tension perfectly here.
I agree. To summarize my position, authID is the definition of a show-me story. The technology is impressive. I will not deny the elegance of the privacy key architecture, but investors cannot eat technology. The negative revenues in Q3 2025 and the substantial cash burn make this a gamble on survival. My final thought is this. Investors must watch the cash runway and insider selling closely. The shift to enterprise sales is difficult, expensive, and slow. If you buy this, you are betting they can sprint a marathon while bleeding out.
And to summarize my perspective, the market has priced AUD for bankruptcy, completely ignoring the privacy key moat and the massive opportunity in agentic AI security. The negative sentiment is purely backward-looking. My final thought is that if the company survives the transition to the Fat 100, and with the pipeline and new partnerships, I firmly believe they will, the upside potential of 5x to 7x is mathematically supported by industry multiples. It is a high-risk, asymmetric bet on the future of digital trust.
It certainly isn't boring.
No, it is not. And that is the complexity of investing in microcap turnarounds versus the clarity of the technological solution. There's always more to explore in the material.
Indeed.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.